Hello everyone, my name is Kapches, President of Chestnut Park Real Estate, and today I'm going to provide you with the May market report for the greater Toronto area. No real surprises in the data that comes out of the May statistics. We see falling sales that started in March into April into May, all due to rising interest rates. As you know, the Bank of Canada benchmark rate, as we speak, is 1.5%, up fairly substantially from where we were in March. That's had an impact on mortgage interest rates. Again, as we speak, mortgage interest rates are 5-year fixed term starting to approach 5%. Not quite there yet, but 6.7%. But they're going to get there eventually, particularly since the bank has already signaled that interest rates are going to continue to rise because of inflation. Inflation is the big concern that we have right now. Again, currently inflation is a little under 7%. A bank would like to see that come down. It'll be interesting to see how forceful the bank attempts to do that, because if the bank is too forceful, it's going to draw the economy into recession, and then of course it's a very different economic situation, not only for the resale real estate market, but for all markets generally. So inflation has gone up. Bank has increased its benchmark rate. Mortgage lenders have increased their mortgage rates. As a result of that, the market has cooled. Psychologically, buyers are in a different place. They're also in a different place because it's now more expensive to service debt. So some fringe buyers who were very rate sensitive are either out of the market or certainly in a wait-and-see position. Hence, we're seeing sales go down. Having said that, sales are going down from extremely lofty heights. In February of this year, we broke all kinds of records for sales as well as for the average sale price, which was in excess of $1,330,000. The sale price, the average sale price has come down, as have sales, but what has to be emphasized is that the inherent economic forces that drove the market through the pandemic, those forces were in play before the pandemic. They're going to be in play when this interest rate cycle is through, and they're primarily driven by supply and by demand. And notwithstanding that we have these higher rates, and notwithstanding that sale numbers have come down, as has the average sale price, we continue to have large amounts of immigration moving into the southern Ontario region, in the GTA, and in the city of Toronto. That continues to add pressure on the demand side because the supply side is not keeping up with the number of people that are in the market looking for homes. So what do we get in the month of May? We get sales down by almost 40% compared to last year, height of the pandemic. Average sale price still came in at $1,212,000, which is 9% higher than it was a year ago, which was $1,108,000. So even though the sale price has come down, it's still up compared to last year. And as I see it unfolding, it's going to probably plateau over the summer months, maybe another $30,000, $40,000, $50,000 less than where it currently is. And that will probably remain through the remainder of 2022 until we get into 2023, and we see by that stage whether or not the Bank of Canada's attack on inflation has succeeded without taking us into recession. If that is the case, then you'll see the market starting to pick up, very similar to where it was before the pandemic, and you'll start to see the same economic pressures that were there before impacting the market as we go forward. A couple of things that need to be pointed out is as we move through this period, different segments of the market are going to operate differently. Clearly, as I mentioned a little while ago, anyone that's very interest rate sensitive is probably either not going to be in the market or is going to downscale their expectations. We're probably going to see the condominium apartment market stay stronger than, say, ground level accommodation, primarily because it, from a price point, is at the low end of the economic housing spectrum. Similarly, at the top end of the spectrum, that is properties that are valued at $2 million or more, probably will be a little bit stronger than the overall market, because again, in that price point, buyers might not be as interest rate sensitive as in the lower or middle range. The other thing that we're seeing, and it's already quite evident, is a dramatic change between what we saw during the pandemic, namely people moving to the 905 region, getting more space, belief in more safety, sanctuary from a less dense environment. That has changed, and as people have become vaccinated and as the city has opened up, we're starting to see a disproportionate number of sales taking place now in the 416 as opposed to the 905. And again, we're going to see 905 prices probably come off more so than the 416 for that reason. So very interesting market that we're in right now. And with interest rates continuing to go up, we may actually see more disruption of this nature, and also a marketplace that is operating on a homogeneous basis. I will discuss all of these changes in the market as we progress through the summer months and we see how the Bank of Canada attacks inflation and with what kind of vigor they do so, because they too have to be conscious of the fact that we don't want to slip into a recession. So very interesting market, very diverse market, as I said, not homogeneous, almost an exciting market to be analyzing. And I look forward to bringing you the June report when we get the data a month from now. Till then, stay well, stay safe. Thank you.